Welcome to The Explainer. Today, we're unpacking a really fascinating piece of institutional research from S&P Global. It tackles one of the most silent but absolutely significant risks to your long-term investment returns. I want you to think of me as your personal financial mentor today because we're going to take this high-level, complex institutional data and translate it into a totally practical guide for your own retirement planning.
Okay, let's dive right in by asking a really critical question, one that basically sets the stakes for our entire analysis today. What actually happens to a portfolio when inflation hits? Think about it. When the cost of living skyrockets, the purchasing power of your hard-earned savings just starts to quietly evaporate. Honestly, it's a terrifying thought for anyone trying to plan a secure future.
So here is our game plan for today. We're going to cover 5 steps: understanding the threat of inflation, measuring asset sensitivity, predicting market regimes, comparing static versus dynamic strategies, and finally, building your ultimate all-weather portfolio.
All right, starting with Section 1, the threat of inflation, the antagonist. Because, to build a strong defense, we really need to understand the historical devastation of our enemy first.
Look, if you've only been investing for the last decade or so, you might have a bit of a false sense of security. From 2011 to 2020, we literally lived in the lowest inflation decade on modern record. It was easy, but extreme economic conditions can and absolutely do result in extreme inflation. Go back to the 1970s, right? The oil crisis helped push annual price increases well above 10%, and that extreme pain spilled straight over into the early 1980s. The research points out that starting in 2021, the trend clearly began turning upward again. We just cannot rely on recent, comfortable memory to plan our long-term futures.
And here is the really scary part for us everyday investors. It's how standard investments react to these spikes. The data shows that traditional core equities and conventional bonds, literally the exact things most retail investors hold, actually deliver below average returns in a rising inflation environment. Meanwhile, alternative assets like broad commodities, real estate, and gold, they wildly outperformed during that massive inflation of the 1970s. So that makes an incredibly strong case for keeping some alternative weapons in your portfolio.
Now that we know what we're up against, let's look at the actual arsenal available to analysts. Section 2. Measuring sensitivity, or inflation beta. Let's strip away the technical jargon for a second. Inflation beta is basically just an asset's inflation sensitivity score. For instance, if an asset has an inflation beta of 5, its return goes up by 5% for every 1% rise in inflation. Simple as that. It quantifies exactly how good a specific asset is at hedging against rising prices. But here's the catch, and it's a big one. It's what S&P Global calls the cost of inflation sensitivity. Yes, you can totally buy heavy protection with commodities like gold, copper, and crude oil because they have a super high inflation beta. But historically, they bring way higher volatility and actually drag down your risk-adjusted returns when inflation isn't an issue. On the flip side, fixed income assets like bonds have the lowest inflation beta, but they give you much smoother, higher risk-adjusted returns during normal times. So the takeaway? You can't just load up on commodities forever without paying a steep price in your overall long-term growth. So, if we know different assets work better in different environments, the next logical step is figuring out how to forecast that environment. That brings us to Section 3, predicting future market regimes.
I absolutely love this weather forecast analogy. Think about it. You wouldn't wear a heavy winter parka in the middle of July just in case it snows, right? No, you just look out the window. In finance, this is called the naive forecast. The research found that simply looking at the current month's inflation rate is a highly accurate predictor of the next month's inflation regime. You really don't need these highly complex predictive economic surveys. Just looking out the window is historically over 90% accurate at matching regimes.
And this brilliantly lays out the 3 distinct weather patterns, or inflation regimes, that S&P Global defined for their backtesting. Low inflation is anything under 1.5%. Medium is between 1.5 and 2.5%. And high inflation is anything over 2.5%. We are simply trying to categorize the weather so we know exactly which financial clothes to put on, whether that's a t-shirt, a light jacket, or full winter gear.
Now that our weather is mapped out, let's contrast the actual battle plans used to defend portfolios. Section 4, static versus dynamic strategies.
If you are a novice retirement planner, you have almost certainly been told to use the classic 60-40 portfolio. 60% equities, 40% bonds. It's standard advice because, honestly, it shows impressive long-term performance. But the research highlights a massive, glaring flaw. It is entirely static. It has zero allocation to commodities, which makes it highly vulnerable to prolonged high inflation like we saw in the 70s.
It literally never adjusts its composition. It's kind of like a broken clock that will not help you survive a sudden inflation shock.
So let's contrast that static approach with two targeted strategies tested in the S&P research. The first is called Pro-IB, where assets are weighted proportionally to their inflation beta. This strategy acts as a super heavy shield against inflation and focuses heavily on commodities. The second is Vol-W, or volatility weighted. Now, this strategy actively minimizes volatility by relying heavily on stable fixed income assets.
When you look at the weight distributions for these two strategies, the contrast is night and day. The Pro-IB strategy dominantly overweights broad commodities to fight off inflation. Meanwhile, the Vol-W strategy shrinks commodities down to almost zero and relies heavily on the safety and stability of bonds. They are complete opposites, specifically designed for entirely different weather conditions.
Okay, finally, let's look at the ultimate defense implementation. Section 5, Building an All-Weather Portfolio.
So, how do we make this actionable for your actual retirement account? By creating a dynamic strategy that automatically switches gears based on the current weather. S&P Global tested a combination they call the 60-40 Vol-Weight Pro-IB dynamic strategy. Here's how it works. In step 1, when inflation is low, the portfolio deploys the standard 60-40 allocation to capture all that strong equity growth. In step 2, if inflation creeps up to medium, it automatically switches to the vol-weight strategy to grab better risk-adjusted returns through fixed income. And in step 3, if we hit a high inflation storm, it switches entirely to the Pro-IB strategy, aggressively overweighting commodities to protect your purchasing power. Seeing how this builds visually over time is just wild. Look at how drastically the asset class allocations shift up and down over the entire 20-year backtest. The second the regime changes, the portfolio aggressively reallocates to ensure it's always wearing the right clothes for the weather. The result of this adaptability is completely profound. As the S&P Global research concludes, dynamic portfolios time their exposures to various inflation-sensitive assets, overcoming some of the performance drag that would result from using just one or two assets. This dynamic approach brilliantly solves that cost of sensitivity problem we discussed earlier. You get the commodity shield exactly when you need it, but you don't suffer the drag when the skies are clear and sunny.
So, as we wrap up this explainer, I really want to leave you with a provocative question as you think about your own retirement planning. Is your portfolio built just for today's comfortable weather, or is it dynamically prepared to survive tomorrow's storm? Adapting your strategy could literally be the difference between retiring comfortably and watching your purchasing power disappear. Thank you so much for joining me on the explainer. Keep learning and keep planning.